So yes, I think we'll have gold going into portfolios next year, small allocation. They'll decide that's a good thing. So probably as we go forwards to the year end, we'll have this volatility up, down a little bit, but more of a sideways movement. I mean, so probably we go right through to perhaps Christmas, but at some point towards the end of the year, I expect people to anticipate this move by investment managers as gold gets added to the asset allocation for 2026. So we might get a strong end of the year rally. Again, not investment advice, I'm just saying what I think might happen. And then, of course, if once it's in the asset allocation tables next year, probably gold can continue its longer-term rally.
Clive Thompson says gold has cooled off after its powerful surge earlier this year. The metal peaked around $4,300. Some even quote $4,380 on October 20th before easing lower and settling into a sideways range. He thinks there's still room for a modest correction, possibly down to $3,500, but nothing that suggests a major breakdown. What's happening looks more like a healthy consolidation after an extended rally rather than a reversal. Thompson expects this quiet phase to last through the remainder of the year, perhaps until Christmas, as markets digest the recent move. The bigger story, he says, comes next year. Institutional investors and fund managers are likely to start adding gold to their portfolios, and the reasoning is becoming clearer. Backtesting now shows that gold ownership in recent years would have smoothed volatility and actually lifted total returns. Markets are backward-looking by nature, he adds. Participants tend to act only once they see evidence that something worked. That shift in institutional thinking could set up a year-end rally as traders anticipate those allocations. Once official fund mandates begin including gold in 2026, Thompson believes the longer-term uptrend will resume in full force. For now, gold is holding steady near $4,014, up $11 on the day, and showing broad-based strength across major currencies. In British pounds, it trades around £3,054, still roughly £200 below its record near £3,260. Thompson's view is that these consolidations are opportunities, not warnings. The market is catching its breath before the next leg higher. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Gold came off from its highs of, the high point was $4,300, or roughly, maybe some people said 4,380, which was set on October the 20th. Let's look at gold and see how that's doing. I'll bring that up on the screen. So here you see the gold price. There's your peak at $4,380, and you can see it's come off here, and now it seems to be trading potentially in a sideways range. It might go lower. I mean, it could easily retrace to 3,500. By the way, this is not investment advice, it's just a personal opinion. But I think we're sort of getting towards the end of the year, and I think it's quite likely that next year many investment managers will decide to add gold as part of their asset allocation strategy. Why will they do that? Because the maths will prove that had you had gold in your portfolio over the last few years, it would have reduced volatility and improved returns. So mathematically, it makes sense to put gold in the portfolio. And I know it's weird to make these decisions after the event rather than before it had happened, but that's the real world of the markets. They constantly look at the past, analyze what asset allocation would have been best, and then make the next asset allocation like what would have been best in the past. So yes, I think we'll have gold going into portfolios next year, small allocation. They'll decide that's a good thing. So probably as we go forwards to the year end, we'll have this volatility up, down a little bit, but more of a sideways movement. I mean, so probably we go right through to perhaps Christmas, but at some point towards the end of the year, I expect people to anticipate this move by investment managers as gold gets added to the asset allocation for 2026. So we might get a strong end of the year rally. Again, not investment advice, I'm just saying what I think might happen. And then, of course, if once it's in the asset allocation tables next year, probably gold can continue its longer-term rally. Gold is doing very well today, well, reasonably well. It's up $11. It's at $4,014 as I do this, and it's rising in Swiss francs, there in euros, in Japanese yen, and let's look at pounds. So in British pounds, the price is at over 3,054. Not forgetting the peak in British pounds was 3,260, let's say. So we're £200 below the peak for the British investors. And we're going to talk about it in a minute, but I'd just like to remind UK investors that if you want to hold gold in a UK self-invested pension plan, it is possible, and there's a link below this video if you're interested in finding out more about that. And that's from Gold Bullion Partners in the UK. Over the last week or so, we've had the US Federal Reserve cut in interest rates. They cut rates by 0.25%. It was widely flagged as a likely thing. But perhaps the surprise was, there were two surprises really. The first one was that Chairman Powell signalled that a cut in December, which was widely flagged before this meeting, he signalled the cut in December was far from a sure thing. And the second thing, he announced that as of the 1st of December, the central bank will cut or stop completely its quantitative tightening program.
Clive Thompson says the Federal Reserve's latest decision was expected in one sense but surprising in another. The Fed cut interest rates by 25 basis points, bringing the range down to 3.75 to 4%. It's the second rate cut of 2025, but what caught the market off guard was Jerome Powell's tone during the press conference. He hinted that this could be the final cut of the year, an unexpected signal for traders who had been almost certain another would follow in December. Before Powell spoke, the odds of a December cut were above 90%. Within hours, they dropped to about 60%. Thompson points out that the vote inside the Fed wasn't unanimous either. Steve Miron pushed for a larger half-point cut, while another member argued for no cut at all. The result, a middle-ground quarter-point move, suggests growing tension within the central bank about how much easing is safe in the current environment. The other big shift was the Fed's decision to end quantitative tightening QT, starting December 1, 2025. QT had been steadily removing liquidity from the system by allowing bonds to roll off the Fed's balance sheet. Stopping it means more liquidity will remain in circulation, a clear positive for markets, though it risks reigniting inflationary pressures. Let's get back to the interview.
We'll start with the policy shift at the US Federal Reserve. Apart from cutting its interest rate by 25 basis points to 3.75 to 4%, that which was the second cut in 2025, the big news on that was that the Federal Chair, Jerome Powell, hinted that this might be the last cut for this year. That was a change of plan from what everybody was expecting, because they were expecting another December cut. So I think the probability of a December cut is something around 60% now, down from it was well into the 90s before he spoke. So we also know that this decision by the Federal Reserve to reduce rates by 0.25% to 3.75 to 4 there were two dissenters at the Federal Reserve. I think it was Steve Miran who wanted a half-point cut, and there was another board member who wanted no cut at all, so they kind of balanced out, and the rest were in agreement that the cut should be 0.25%. The other important announcement from the Federal Reserve was the announcement that quantitative tightening, their program of quantitative tightening, would end effectively on the 1st of December 2025. So what's quantitative tightening? Quantitative tightening is the process of reducing the Federal Reserve's balance sheet by letting bonds mature that's the bonds owned by the Federal Reserve, and then they don't reinvest the proceeds, they get paid the money. Now, when you're doing that, that's kind of withdrawing money from the economy, reducing liquidity in the economy, which is a process which obviously is designed to rein in inflation a little bit, but it also should keep prices of assets like stock market in check when they're withdrawing money from the system. So basically, they're going to stop withdrawing money from the system, which many people see as a bullish sign for investors, because when you end quantitative tightening, it's going to increase the liquidity in the financial system, pushing up asset prices. So investors are, broadly speaking, welcoming that news, although I think you've got to be a little bit careful what you wish for, because we might move into a period of higher inflation. I mean, I think the Federal Reserve is torn between, do we fight inflation with higher interest rates, or do we help unemployment, which is definitely a problem. There's too many people becoming unemployed at the moment, and you want to lower interest rates to encourage investment, to encourage companies to hire, to build factories and hire back the workers. So on the one hand, they should be reducing rates. On the other hand, they should be increasing them, and they're sort of stuck as piggy in the middle, not knowing which way to jump. So what comes after quantitative tightening? Well, the next step might well be quantitative easing. Quantitative easing is the opposite. It's where the Federal Reserve would expand its balance sheet. Now, they haven't said they're going to do that. That's not on the cards yet. But if there's a problem with interest rates or yields on government bonds, if yields start to rise and they reach unacceptable levels, when I say unacceptable levels, if they reach the level where the US Treasury, the government, doesn't want to sell bonds at that high rate, i.e. they don't want to borrow money at these higher rates because it's going to spiral out of control, then the Federal Reserve can step in and start to buy government bonds, printing the money. So that's very relatively inflationary. They put money into the system, but they buy the government bonds to stop the yields rising beyond a certain point. So that would be quantitative easing. But of course, when they do that, their balance sheet expands because they print the money. That's more liabilities. And they buy the asset, the bonds, that's more assets. So the size of the balance sheet gets bigger, more assets and more liabilities. In the USA, we've got this government shutdown which continues. We're now into the 6th week, and there's no end in sight.
Momentum in gold often fades before the next major surge, and right now, that's exactly what's playing out. The metal's pause isn't exhaustion, it's recalibration. Clive Thompson's view captures a crucial shift happening beneath the surface, the transition from speculative enthusiasm to institutional validation. Gold's recent cooling isn't weakness, it's the market adjusting to new realities as central banks, fund managers, and risk models begin to accept what retail investors already know. Once gold becomes a fixture in official portfolio mandates, its role will evolve from hedge to cornerstone. That's the inflection point markets rarely recognize in real time. Meanwhile, the Federal Reserve's mixed messaging adds another layer of complexity. Rate cuts signal caution, yet the pause in tightening hints at fear of breaking something deeper within the system. When monetary policy wavers between easing and restraint, gold quietly benefits. Liquidity doesn't vanish, it migrates. And it tends to flow toward assets that sit outside the credit matrix. As 2026 approaches, the real question isn't whether gold's rally resumes. It's whether this consolidation marks the moment traditional finance finally accepts gold not as a trade, but as essential collateral in a world that no longer trusts its own money. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.